So good morning, everyone, and thank you all for joining us on ESMA's webinar. My name is Aleksandra Bojanic. I'm from ESMA's communications team. And before we start, let me go through some technical information. So this webinar is recorded, and the recording will be published on ESMA's channels together with presentation. And we will send the links to recording and to presentation to all attendees after the webinar. During the presentation, you can provide your questions by using Q&A's option at the top of your screens. But please be aware that the questions will be addressed at the end of the presentation, so at the end of the webinar. And all attendees are muted and with camera turned off. You cannot unmute yourself or turn camera on. And now we can start with welcome remarks from Mr. Stefan Kern, the head of Economics, Financial Stability and Risk Department. Please, Stefan, the floor is yours.
Alexandra, thank you so much for the introductory words. Thank you. And a warm welcome also from my side to all of you here on the call. It's great to see so many of you taking an interest in our analysis that we're presenting today, namely the article that we published on the scale factor, the impact of size on EU fund costs and structures. It's a very important article in our work that both contributes to our consumer protection mandate and also to our wider view of the development of the European financial markets, not least in the context of the Savings Investment Union. The subject of our article actually emerges from a long-standing work that we at ESMA have been doing for many years now, and that is related to the cost and performance of EU retail investment products. As you may know, we publish every year an annual report on the costs and the performance of investment funds and other retail products in the European capital markets, where we try and inform both policymakers but also the wider consumer community about the evolution of costs in the sector. And through our reporting for a number of years now, it has come through that actually there is a relationship between the size of share classes of funds as they are offered on the one hand and the associated costs that the funds charge, especially on an ongoing basis, to clients in the market space. So there is this relationship. We saw that in our ongoing reporting, and we took a stronger interest in the drivers of the fund cost structures according to the size. In order to do so, we have now published the analysis, the deep analysis that we did on the cost structures, and in doing so, we investigate the relationship between the size of share classes on the one hand and the cost of share classes in greater detail on the other hand. We also analyze the role of parent companies and how their size actually affects the costs of the share classes, and we also offer a comparison between the findings that we have for the European Union and other jurisdictions, in particular the US fund market. So the findings that we reach, and no secret around this one, that we find that relationship between the size of the fund companies and the products and the costs of the products themselves is an important addition to our view of the European market. And we hope that this actually informs both clients, but also the wider policy community, as we are these days discussing enhancing the competitiveness and the dynamics in the European capital markets, in particular the fund sector. We'll get some greater detail on the analysis by our lead analysts on the investor protection work, that is Spiros Tziolis, Natasha Mosson, and Lorenzo Danieli in our department, who will give you all the details on our findings. After that, our colleague Yuri Beuten, he's a senior policy officer in the ESMA Investor Protection and Intermediaries Unit, will discuss with you the relevance of these findings from a policy and supervisory perspectives. And thanks for joining us, Yuri, on this occasion. This is great. And finally, we'll have an opportunity for a Q&A session, which will be moderated by Claudia Gugliano. She's the head of the Consumer Sustainability and Innovation Analysis Unit at ESMA, where She and my colleagues will be happy to answer any questions that you might have. And Alexandra said it already. Please enter your questions into the chat function right away. So I hope this is interesting for you. We are very much looking forward to first sharing our insights with you, and then also to discussing with you in the context of this webinar. I wish you a very interesting event, and I hand it over to Spiros right away. Spiros, please.
Thank you very much, Stefan, for the introduction, and welcome everybody to today's webinar. So today we would like to present to you the results of our analysis about the impact of size on EU fund cost structures. A few words on the motivation and the background of the study, of this analysis. So there are several studies in the past that have showcased that costs from EU largest funds tend to be lower compared to costs charged by the EU smallest funds. And this can be mainly driven due to the economies of scale that might prevail in this context. As you can see in the chart on the right-hand side, we showcase the costs charged from equity, large and smaller equity funds across different investment horizon. And as you can see in the chart, larger funds in general tend to charge lower costs in terms of different types of costs: entry costs, exit costs, and ongoing costs. However, beyond the surplus and fund size, we would like to investigate if economies of scale prevail in the group level, so the parent company level, and if the size of the parent company might have an effect also in the cost charged by the funds. So this is a scope that we take into consideration in this analysis. And in addition to that, having a comparison with the EU and US fund markets, in 2022 in general, US fund mutual funds were on average more than 8 times larger. So we would like to see the correlation between the size and the costs, and do similar comparison between the EU and US fund markets. A bit of a background on the data that we used in our analysis. So as you can see in the slide, we mainly used 3 sources of data. So we retrieved information from Morningstar with regards to information about the share class and the fund characteristics. So we collected information on equity, bond, and mixed funds. Then from Leaper, we managed to obtain information on the fund Manco level, and also from Icon, we managed to retrieve information on the parent entity level and their characteristics, namely their assets or their business sector and economic activity. This could lead us to a sample of around 47,000 EU share classes and 70,000 US share classes, for which we would have available information on certain characteristics. So the share class costs, their assets, and also their parent assets. In the sample for both EU and US, the majority of the share classes are in category of equity, with bond and mixed following up. And also with regards to the parent entities, we noticed that in the EU market, the majority of those are domiciled in Germany, France, or also in the US. Looking into the concentration with regards to these markets, US and EU markets, we noticed that the US market seems to be more concentrated compared to the EU. So as you can see on the chart on the right-hand side, we showcase that, for example, the top 5 parent entities in the US hold around 65% of the share classes AUM, while the corresponding figure for EU is around 22%. And also, looking also on the top end of the top 25 largest parents, we can see again that they hold 90% of share classes AUM in the US, while 66% is about the EU. So as you can see, the US market seems to be more concentrated compared to the EU, while the discrepancy that might exist in the EU might be caused due to discrepancies that exist in different country members in the EU area. And this can have also an impact of the cost charged by the funds. In addition to that, we looked into the relationship, the correlation between the share class the parent size. So as you can see in the chart on the right-hand side, in general, largest share classes tend to be held by largest parents. This holds especially for the EU. But on the other hand, we notice that largest parents in general hold a variety of share classes and not necessarily the largest ones. On to the next slide, we would like to showcase the relationship between the size of the share class and the costs in the EU market. So we have created this chart that you can see on the right-hand side, where in the x-axis you can see the share class assets split in different buckets based on the distribution of the data that we had, and the corresponding costs of each bucket. So as you can see on the chart, there is a downward tendency. So as we move along to higher buckets, costs tend to be lower. With regard to the first bucket, you can notice that the median cost of this bucket is the lowest across all buckets. And it's composed mostly by young share classes that were quite recently launched. And just to put it on a reference, so we are talking about the majority of the share classes were around 2 years old, while for the rest of our sample, the median age was around 7.5 years. And this can attribute the fact that they charge lower costs in order possibly to attract new investors. And going into the next slide, we do a similar comparison with the US. So same rationale behind the chart that you see on the right-hand side. So there is this downward tendency as for the EU market, but we notice two discrepancies with regards to this. The one is that as the share class assets increase, we notice that the decrease in costs is more significant, is larger in the US market. And on the other hand, that costs in the US tend to be less dispersed compared to EU ones. So as you can see on the box plots, the costs tend to be more concentrated around the median compared to what we observed in the EU market. Now, for the next part, I will hand over to my colleague Natasha Moshun so she can continue.
Thank you, Spiros. Good morning, everyone. So to empirically examine how share class costs relate to the size of the share class and its parent, we first employ a cross-sectional regression analysis. The dependent variable is the ongoing cost or the net expense ratio in case of the US fund. And for the explanatory variables, we include the net assets of the share class, the parent assets, and we also include share class control variables such as the age of the share class, and also fund control variable such as the asset class of the fund, for instance. And in a second step, we will replace the ongoing cost by entry and exit costs, and we will also introduce parent control variable. Next slide, please, Spiros. Thank you. The results from the OLS regression show first a significant negative correlation between the size of the share class and the costs of the share class. In other words, larger share classes are associated with lower ongoing costs, both in the EU and in the US. This finding confirms that economies of scale could be a potential driver of lower cost. But we also notice in the right-hand side table that the coefficient is higher for the US compared to the EU. It means that the negative relationship between share class size and share class cost is more pronounced in the US market. This could potentially indicate that US funds achieve greater cost efficiencies as they grow with respect to their EU peers. The results from the OLS regression also show a significant negative correlation between the size of the parent and the cost of the share class. In other words, the share classes managed by larger parents are associated with lower ongoing cost. But here there is no apparent distinction between the EU and the US, as the two coefficients are nearly identical. We also find that other factors can influence the cost of the share classes. For instance, the asset class, where bond funds tend to be cheaper compared to equity or mixed fund. Also, the type of management or the age of the share class, as share class launched more recently tend to be associated with lower ongoing costs. Next slide, please, Piros. Thank you. As mentioned previously, we've included in a second step parent control variables. The first thing to know is that the main finding still hold after including those control variables. But it also shows that EU funds with US parents tend to be cheaper than EU funds with EU parents. We also replaced in the regression the ongoing cost by entry and exit cost. Here the results are more ambiguous but still significant. We observe that larger share classes are associated with lower entry cost and higher exit fees, whereas share classes managed by more sizable parents exhibit a lower exit charges. This was the result for the first part of the analysis. For the second part of the analysis, I'll leave the floor to my colleague, Lorenzo Danieli. Lorenzo, the floor is yours. Thank you.
Thank you very much, Natasha, and good morning, everyone, also from my side. So in this part of the analysis, we want to examine the relationship between cost and fund or parent size across different points of the conditional distribution. And so the difference with the analysis before is that now we want to take a look at very similar funds based on costs and see whether these relationships hold across different buckets of the cost distribution of fund. This analysis allows us to reveal whether there are potential heterogeneous relationship, not only across cost buckets, but also between EU and US funds that can be masked by the regression that we saw before. It is important to say that here we're not distinguishing or making any difference between whether whether EU funds are cheaper than US funds, but we're just taking a look at whether there is a stronger or weaker relationship between cost and size across the two quantiles and countries. So we are interested here in the regression in beta 1 that represents the estimated effect of fund size on cost at the quantile of the conditional distribution. So we're going to visualize the results into plots across quantiles to really illustrate the potential heterogeneous effect across the distribution of costs. So in the next slide, we can see the first result where we ran the regression between the size of the fund and the costs. And here also the quantile regression confirmed the fact that larger share classes tend to be less expensive than smaller share classes. But what we notice is a big discrepancy in the effect that we have among EU funds and US funds. Basically, this indicates that US funds have a stronger relationship between negative relationship between cost and size as the size grows, and could potentially indicate that they achieve greater cost efficiencies as they grow with respect to EU peers. If we take a look, on the other hand, at the parent size, here we see that in the next slide, we see that in the EU, we have a slightly stronger negative relationship, even though the magnitude of the coefficient is very similar, and almost then we can conclude that the effect is similar between EU and US fund. However, we could potentially interpret this result that despite the EU being a more fragmented environment, EU parent companies are slightly more effective in leveraging on large scales and reducing costs with respect to the US. And mainly, we are speaking about banks here in terms of parent companies. So, going to the next slide, let's resume the article in a nutshell before leaving the word to the floor to the discussion. So we've seen through this analysis that first of all, large share classes are characterized by lower cost than smaller share classes, and this relationship is stronger for larger US share classes. And also, this relationship is confirmed when we take a look at parent companies. And so the share classes that are held by larger parent companies tend to have lower costs. And our econometric analysis also suggests that these results seem robust and confirmed. And also, if we want to frame it in the current, in the latest policy developments, also we can conclude that first of all, size advantages can lead to greater cost efficiencies, and mainly they indicate that greater consolidation at EU level could reduce cost for EU investors, and therefore may have greater benefits overall to the end consumer. And from an investor protection perspective, here we have identified a critical need to ensure that efficiencies of scale are effectively passed ultimately on retail investors. And finally, our analysis suggests that investor awareness on fund costs and their relationship with share class size is key for making optimal investment decisions. With this, I thank you very much for the attention. I leave the floor to our colleague Yuri Boyton for the discussion. Thank you.
Yes, thank you very much, Lorenzo, and all the colleagues for this work. It's a very interesting article and presentation, and I believe it can be really helpful in future policy initiatives for the SRU, but also for ESMA, for instance, on the information to clients related to the last points you just mentioned. And I have two questions for the discussion, and both relate to potential future research we could do. So the first one relates to the interaction of the cost and the fund size, because what I saw in the article is that it's based only on 2022 data because of data availability. But what struck me is that on slide 6 and 7 you showed that the the smallest percentile had so with the smallest funds had the lowest cost. And one of the possible explanation is that maybe it's the newer funds that are cheaper, and therefore this class is cheaper as a whole. And that makes me wonder about the relationships between fund size and cost. So if we have like a multi-annual view, could we see whether it's more like that the funds grow over time and then become cheaper each time they reach a certain threshold? So for instance, if they become 1 billion or 2 billion, do the costs drop? Or is the relationship more that they are cheap from the offset, and then because they are cheap, they attract more investor money and they could become the larger funds? I think this would be interesting also from the retail investors' perspective and the policy perspective, because this also makes you think how the costs interact, and are they lowered when they can be lowered, or do they stay sticky? So this is my first question for potential future research. And the second one relates to more what I was thinking about as a private investor myself. Okay, but how does this relate to individual funds tracking exactly the same benchmark or the same index? So just like a regular private investor, I went online and tried to find some public information. While this paper focused on non-ETFs, I only focused on ETFs because that was the only data I found available, both for US and EU, without any subscription or otherwise. And I looked up two different products, so the Eurostoxx 50 for Euro product, and then MSCI World ETFs. If you could go to the next slide, I would like to start with what I found for the Eurostoxx. What I saw interestingly for the Eurostoxx is that there are quite some funds available, or ETFs available in the EU, but the costs are more or less the same for each share class, irrespective of the fund size. So there's one exception, but the rest is all 10 basis points or less. So that's rather cheap, and also cheaper than the cost for the only one fund I found in the US that tracks the same index. And given that many of these ETFs are available at, for instance, neo-brokers that offer low commissions and low ongoing service fees, I think for this product in the EU, investors might be better off. But more interestingly, on the next slide, when I looked at the MSCI World, I saw greater differences in price, ranging from 10 basis points highlighted in blue to 50 basis points highlighted in purple. And also only I only found one MSCI World ETF in the US with 24 basis points, so that's in the middle from the costs we see in the EU. But what is interesting to me is that the cheapest ones here, so the one in blue, there aren't really big if you consider that the biggest is 90 billion and they only have 1.7 and half a billion. And that even there's in purple, the most expensive one with 7 billion, that's also way bigger, for the one from iShares. While iShares itself also has two similar alternatives that are 30 basis points cheaper. That makes me think, back from the policy perspective, why are these investors invested in this 50 basis point product while there are available 21 cheaper ETFs, including two from the same issuer? Does it mean that the funds are sticky? So once a retail investor has chosen a certain fund, it keeps investing in that fund, and it doesn't look anymore for better alternatives. While there are costs involved in switching, we don't know. So therefore, for future research, I think it would be really interesting to have a look into the drivers for retail investors. Why do you choose a certain ETF in this case, and not another alternative one? It can have to do with availability, of course, if maybe they're not available at certain brokers due to distribution arrangements. What's also interesting is that in both examples, iShares and Xtrackers were the two largest ones. It can also be the case that branding is really important in this case. People know these brands, so they know they're trustworthy and they buy them. But yeah, it can also be other reasons. Maybe it's the lack of the ease of comparison of the cost. So maybe we need to do some work in that regard. And therefore, to summarize, I think it would be really interesting to have further research in these drivers and to see how we can help with policy initiatives, how we can contribute to sensible investment decisions. And I think with that, there are my questions, and I give the floor to Claudia for the Q&A session.
Okay, thanks a lot, Yuri, for the discussion, and thanks to my colleagues Natasha, Lorenzo, and Spiro for presenting the paper. First of all, let me look at my colleagues. Do you want to reply, or do you have anything already to share based on the discussion and the suggestions from Yuri? Not really. I think a lot of ideas for future research, I suppose. But Natasha, would you like to say anything?
No, indeed. Thanks, Claudia. I was just going to say that indeed it's interesting idea that Yuri shared with us for future research, indeed.
Okay, thanks a lot. And let me clarify again that if you'd like to ask any questions, please write them on the Q&A area. We have a first question, which I don't understand if it is for Yuri or if it is for the authors of the paper. When comparing the cost of ETF, did you consider the difference between synthetic or physical ETF?
Maybe this one is for me, since it refers to ETFs. Yes, I think out of my head, for the Euro stocks, they were all physical replication, and indeed with the MECR world, there were some that were swap based and some that were optimized replication. But yeah, this was just to have given an overview, and for the regular private investor, most of them probably won't even know what the difference is.
This is a very good point. Thanks, Yuri. And then there is a question around passive and active funds analysis. I think, Natasha, on this one, we have done quite a lot of analysis. I don't know, please, if you want to say anything.
Yes, sure. So in our database for this article, we have both active and passive non-ETF fund. Of course, we in the regression analysis, we control for this because we know from our past cost and performance report that passive fund are on average cheaper compared to similar active fund. So of course we control for this. I mentioned during the presentation that we have it's one of the control variable we included in the regression, which distinguish between active fund and passive fund.
Thanks a lot, Natasha. And maybe to add that even when we control for active and passive, the results on share class size and parent size are still confirmed and are still relevant and significant in statistical terms. There is a question that is really on the methodology. Why did we use the size of the share classes rather than the size of the fund? Because maybe the economies of scale could be more relevant at fund level. Who is going to? Natasha, please.
Okay, I can start. Colleague, feel free to complement. I think one of the reasons is that when we do regression analysis or analysis on the costs, we tend to do the analysis at the share class level because you have differences of costs for share classes belonging to the same fund. You can have different costs, especially if you compare the share class dedicated to retail investors and the share classes dedicated to institutional investors. So that's, I think, the reason why we were at the share class level. But of course, in the regression analysis, we control, for instance, for the type of client that the share class targets.
Okay, thanks a lot, Natasha. And there is one more question on the relationship. If we check the relationship between cost and size, and we analyze the differences existing across EU jurisdictions. I think in this analysis, the analysis done in this article in particular, the analysis is done at EU level, but in our report on cost and performances, we also analyze differences across different jurisdictions in the EU. But I don't know, Natasha and colleagues, if you want to say anything on these specific questions, anything else? No. The analysis is done at EU level in this case. Lorenzo, please.
Yes, thank you, Claudia. Yes, maybe just to flag that in the article, we also include one chart in which we show how the relationship changes across countries. And more or less, we do not observe very large differences across EU countries, except for few exceptions. But yeah, we only consider this at very aggregate level because, as Claudia mentioned, we are really focusing on the EU rather than specific countries.
Okay, thanks, Lorenzo. Let me see if there are more questions. I cannot see any other questions. Let's wait 1 minute to see if there are other questions. Doesn't look like we have more questions, so let me thank you all for the participation to this webinar. You can find the article published on our website, and you will have also the recording available, as Alexandra explained at the beginning. Thanks a lot, and see you at the next webinar.